What is up, and welcome back to How to Invest in Commercial Real Estate. And we are super excited about today's show because we have a guest on who we will introduce in just 1 second. But if you were an investor in our Callaway deal, you got some money this
Congratulations.
week. Yeah, that was exciting. 40+% IRR. We got a 27% return in 8 months. That's why that number is so high. So massive win there.
Sometimes projects go kind of like you want them to, and this was one of those. It went maybe even quicker than we thought. The numbers all aligned. We exceeded our projections on IRR, and it was just a huge win. And we got several other developments that we think are going to be selling soon, but this one was one of the first, and we're super proud of it.
Yeah, don't be spending that money.
Yeah,
invest it.
We're going to bring it. We're going to bring you more opportunities. You can give it back to us, and we'll try to hit you with another 40. Yeah.
Yeah, absolutely. And we've got a lot of other stuff going on, but we won't waste time with that. Let's get right into it. We have Chris Odom, the Executive Vice President of Tulsa Area Lending. I get that one?
Yes.
Yeah, there we go. Of Mabrey Bank, which is one of our favorite banks, if not our favorite bank. I love working with Mabrey. We shove most of our accounts there, it seems like. Super easy to work with you guys.
Yes.
You know, we originally asked Scott Mabrey to be on the show, and he said he would do it, but then he quickly skewered Chris here and offered him up as the sacrifice. So we're happy you're on, Chris. Chris isn't just a banker, he's a friend, and it really helps to have good relationships with local lenders because you get honesty, you get quick response time, and Mabrey is a good local bank that does both of those for us. So, Brian, we had some questions for Chris because we want to really talk about the current state of commercial lending. It's a little bit in flux as we've had this time of high interest rate, and now we think we're transitioning into a period of lower interest rates or reducing interest rates. So we had a few questions for Chris. Hopefully our listeners will get a lot out of it.
Yeah, overall, I think the first question we have is just from the bank's perspective, what's the overall outlook for commercial real estate?
Yes. I mean, all banks right now are still well capitalized. All banks have good liquidity. The other day I was looking at a report. Most banks right now loan to deposit ratio on average is still like 80%. So there's still a lot of money there that can be lent out for commercial real estate, good commercial real estate projects. What we've seen over the past couple of months is an increase in kind of the construction deals. A lot of deals I think a lot of people have maybe put off for 5 or 6 months just to kind of see what the economy is going to do. Rates start dropping down. We've kind of seen an influx, more people coming and looking at those deals. We've closed a couple of big projects in the last month, and we've got a couple other larger construction projects right now.
What kind of construction projects? What asset class?
Anything, right? We've got everything from kind of a specialty use project that we're doing. We've got some multifamily stuff that we're doing. So really, from that standpoint, we've got another kind of specialty use mini storage type facility that we're doing. So really, those are kind of the things we're looking at right now.
Okay. That's all really positive.
Yeah.
Yes.
I mean, construction starting is always a good tick in a market that's growing and getting healthier, right? When you see all construction just kind of cease, which you have for a while, for the past 12, 18 months.
Costs were so high, interest rates were high.
Yeah.
So I got to believe with interest rates going down and building costs are starting to come down a little bit, that activity's really got to be picking up.
Right. It was kind of a double whammy there for a while, right? Like you said, you had it was hard to make deals work just from an interest rate and from a cost standpoint. From the cash flow, it was difficult. Now, interest rates easing a little bit, costs coming down. Those deals are they're starting to take place now.
Okay. Okay, our next question was, how did the banks evaluate deals over the last 12 months with those kind of high interest rates and high costs versus how do you see it over the next 12 months?
I mean, from a bank's perspective, we typically evaluate income-producing properties. We use metrics that kind of take out amortization, take out interest rates. So, and I don't know if your users know this, but debt yield, that's a big thing we kind of look at. We just want to look at, is the proper debt on the facility that can service the debt. We don't necessarily care whether the rate is 5%, 10%, kind of what is
We'll
that?
take 5.
What is that? What you will, right? We might want to take 10 sometimes, but whatever the debt yield is kind of helps us. Because then I can make anything cash flow, really, from a borrower's perspective. If you guys put in a long enough amortization or you get a certain cap rate or whatever, deals can cash flow. But if you use a debt yield, and let's say for us at banks, we typically try to look at 10%. That's kind of the standard. Anything under that, we won't say we won't do it, but then we want to
Let's talk about the debt yield.
Yeah.
Because I'll let you explain it to our listeners. How is the debt yield calculated from a bank's perspective so they know how you're looking at it?
Yeah, from a bank's perspective, the way we look at it is we take your net operating income of whatever that income producing property has. So let's just use really easy numbers. Let's say $100,000, right? So if you have NOI of $100,000, we comfortably feel like that bank or that property can service $1 million loan, right? So that's 10% right there. Anything under 10, so again, it's not saying we won't do it, but then that's when we got to look at it and we got to see, okay, what may make this property different that we would feel comfortable doing it. I mean, I've done 9% deals before in the past, so it's not like you won't do them, but that's a really easy way for anybody to take a look at a project real quick to see kind of what the cash flow is and to see if it works. So that's just a rule of thumb that most bankers use. So I think it's good for borrowers to know that.
And I don't think that's a popular metric from the borrower perspective like you opened it up with. I know a lot of people are just focusing on LTV. I know the past 12 months it's been your debt service coverage ratios,
right.
Just stressing it with the rates. Obviously, you don't have to stress – I would think you wouldn't have to stress the rate too much when we're already at like 7 or 8. But a couple of years ago, the reason you would stress these interest rates is because of now, right? Like what happens when your rate gets up to 8%? Does it fail?
Yeah, so
right.
From your example of debt yield, you have $100,000 NOI, and you said we can loan $1 million.
Right.
Okay, and so then if I said I want an 80% loan, then that's a $1.25 million deal size.
Correct.
And so then if I back calculate the cap rate of that deal of $100,000 NOI and $1.25 million deal size, that's an 8 cap. And so, we're not getting into debt coverage ratio, but just in my mind, I can kind of look at an 8 cap deal and know that I should be able to get close to 80% LTV on a deal like that.
Right.
And if it's a lower cap, I'm going to get a lower LTV, potentially higher cap. I mean, it's hard to get higher than an 80% LTV, but 8 and above, you're going to be good on loan value.
Yeah. So when the bank's underwriting and meeting all these metrics, do you care what asset class it is necessarily?
We don't. I mean, I'll say this. The best asset class right now is multifamily. That is still really strong. We're getting cap rates still 6.5 to 7.5.
By best, you mean?
Strong.
Most reliable.
Cash flow, most reliable.
Stable.
Feel comfortable with it. Occupancy. That's typically the best asset class that we're seeing. Industrial is still really strong. It's doing well. Cap rates that I've seen over the last 3 or 4 months in that is anywhere from 6.5 to, I saw an 8. It was kind of a different project, but they're 6.5 to 8 on industrial. Retail's still hanging in there well, doing good. Cap rates between 7 and 9. We don't have any problems with any retail loan. Occupancies are still doing well, and then office is kind of probably that last segment. Cap rates on that are 8.5 and above, depending on the size of the office and kind of multi-tenant or exactly what's in the office. But really, I would say all the first 3 are doing well, and then even office in some areas is doing well, but just depending on how big a square footage it is and what kind of building.
So if someone came to you and was considering an office project, you might look at it a little closer than you might, say, multifamily.
I would say it's a fair statement. I mean, we look at everything, but I would say that's a fair statement. We're probably going to dig in and see the tenants and cash flow and all that from that standpoint. Correct.
So as we get into this environment where rates are coming down, from a bank's perspective, I'm sure you guys get together and you start to try to forecast, hey, what does 6 months look like? What does 12 months look like? So if you've had those discussions internally, what are you guys thinking about, the next 12 months of commercial lending?
Right. I mean, it's difficult for me to give projections. We get projections, but as I was saying to the guys before we came on, you never know what's going to happen, right? If you have a war, you have, right now you've got union on strike. So what does that do to inflation? So sometimes it's difficult to always predict. We are thinking Fed funds are going to go down quite a bit over the next year. We feel like it's pretty confident they're going to go down. You can see it anywhere from low end of maybe 125 bibs up to high end of 200 bibs within the next year. That's kind of the numbers that we're kind of seeing from a standpoint right now. So a lot of clients, what they're wanting to do, and I would assume a lot of your clients are maybe trying to get floating rates right now because they think it's going to ride down a little bit and they want to ride it down with them. So we kind of work with our clients. We probably have right now half, 50 still want to fix, and probably 50% of them want to do some type of a floating rate.
What's the thought process with the fixed people? Like, what you've heard their argument. What's the thought process? Is it, hey, no prepay, I'll go fix and I'll refi you out, or I know it's going to be lower and it's a short term loan? How do you combat that on your end?
Yeah, I mean, it's still. I mean, if you look at where you're at and where you are, that's still a good rate. You can get a good fixed rate right now, right? I mean, in relative terms to where people were 2 years ago, 3 years ago, they feel comfortable with the rate that they're getting. They lock it in, right? So from that standpoint, the fixed rate people, that's kind of what they're thinking is, I know this cash flows. I like to know what it's going to be, and I have it all in front of me. I don't have to worry about it. You give me a 5-year fix, we're good to go.
Some people just don't like floating rates, I think. Maybe from the past when interest rates have gone up or whatever.
And again, we all think they're going down, right? But
you don't know for sure.
We don't know, right? If there's a war who knows, right? So if we all knew 100%, again.
I bet 4 years ago we were all thinking interest rates were going to stay low, right? I mean, we had no reason.
I don't know. I was when they were that low. I think the last 8 years, I've been thinking they're going to go up, right. and so you never know, but.
Yeah. So a lot of people, again, like they may want that fixed rate. They know the payments. I feel comfortable with it. Let's just do it. That's what they're thinking is.
Not bad.
So I think that's mostly what we had. I think you wanted to talk about maybe how a borrower is evaluated.
Yeah, good point. So, we have a lot of people that are either beginning their quest in commercial real estate or they're considering getting into commercial real estate. And, having been in their position, I was super intimidated when I first started because I just didn't know anything about the lending space, and to walk into a commercial bank and say, hey, will you lend me money? I had no idea what they wanted me to say. I didn't know what they were going to lend me or what requirements they were going to have. So that was one of my questions for the audience is tell us about how if a girl or a guy, 26 years old and has found a small commercial deal and they come into your office and say, hey, Chris, there's this building I want to buy. What are you going to loan on me? What are you going to loan on it? How do you approach both evaluating their first deal and them as a borrower?
Well, the first thing I would say is, again, I kind of work for a community bank, so I'm kind of favorable to community banks. But I think the first thing you do is to find a bank that you feel comfortable in talking to someone, right? So you don't want to be intimidated. You want to find a bank that you feel good coming in and sitting down, and you got a good rapport with the lender, right? So you can sit down and talk to them. When you come in with your first deal, you need to probably have basic things. And what I mean by basic things is you need to have a personal financial statement kind of filled out for them, or they can walk you through it, but a personal financial statement kind of filled out that has all your assets, your liabilities, and your net worth so that they can see kind of what that is. The next thing they're going to want to see is, let's discuss the property. If you have a property in mind, if you have something that you can kind of show them from a standpoint of, I'm looking at this property. Because the first thing that any banker is going to do is, okay, they want to look at the location, what kind of property it is, try to get as much information from that regard as they possibly can. So those two things would be extremely helpful when you walk in, to have kind of a personal financial statement. You kind of have a property there, and then just discuss it with the lender. A typical transaction, these guys will tell you, I mean, most banks, if it's your first time, they may want more than 20 down even. They may want 30% down. So you have to be thinking about that too. How do I get my equity to go into the project? So those are all kind of conversations that you probably need to have in your mind before you go in and discuss that deal. If you're further along in the deal-making process, it's always good to have a rent row. And a rent row basically tells who the tenants are, what's the rent per square footage, kind of how much income each one of those tenants is making. And that's very helpful because that's what that lender is going to use. That's what he's going to analyze when he looks at that deal. So if you already have a property in mind, those are three things. Have information about the property, kind of have a PFS kind of filled out for yourself, and then kind of have a rent row that shows, okay, this is the rent that the property is generating every year, because that's what he's going to use. And then just sit down and have a conversation with him at that point.
So let's say I'm a young beginner and I have a day job and I make $75,000 a year. I have a net worth of $300,000. I don't have a ton of debt, maybe on my house and a car. And I found a retail deal I want you to loan on. So what size of retail deal let's say the retail cash flows. What size of retail deal can Mr. $75,000 a year income guy buy?
Right. I would hate to pigeonhole anybody, but that kind of a situation, you're probably going to have to be pretty small, right? I mean, you're gonna have a situation where you kind of start a little smaller and you maybe work your way
Let's
up.
Ballpark
right?
it. Let's ballpark it.
I mean, I don't know, $200K, right? You and I are just throwing out numbers of a kind of a deal size and maybe a cash flow.
Net worth, kind of similar to the deal size?
Yeah, so pretty similar.
Okay.
Something that's reasonable that bank is going to grow, is going to get more comfortable with you. And the more deals you do with a banker, the more comfort he gets, right? I've got guys that have done 15, 20 deals I feel really good with. And other guys that you just kind of grow with them and you kind of learn as you go along. So I would think you'd want to start out pretty small and make sure that it's something you can handle and it won't overwhelm you. Plus there's a learning curve. There's going to be things happen that you're probably not anticipating or things that maybe go wrong. So the smaller you are, the better that's going to be.
Yeah. So, guys, here's what I want to say about that. Let's say you do have a $300,000 net worth, but it's tied up in a 401k. It's not really that liquid. The bank doesn't think that much about it. Then you have $75,000 income. Well, chances are you're
spending that.
You're easily spending $60,000 of that. Just best case.
Yeah.
So you don't have a lot of excess cash flow. Yeah. So let's say you do get a property and you bought it on 8 cap and you have $1 million building that's making you $80,000 a year to service that debt. But let's say the property doesn't go like you think it's going to go. And so now you lose a couple tenants and you need to supplement 20 grand a month of that 80 grand. Okay. Well, you can't do it, right? You don't have the funds. So that property, if you went and tried to buy $1 million property on that income with those assets, is a couple of hiccups in your income and you're underwater and the bank's taking it back. And so that's what he means by deal size versus net worth or income, or at least available excess income to service this debt. And so like with us, we have a significantly higher net worth now, but we're still buying reasonably small deals compared to the net worth.
And we're stacking guarantors, which helps because they're looking at total personal financial wealth on all the guarantors. I mean, a lot of our loans will have 3, sometimes 4 guarantors. So they're getting all of our net worths.
Yeah, and so like when I started out, if I would have gone and tried to buy a $10 million building, even a $5 million building, right, I would have been a hiccup away from really bad trouble and actually going under, because when I started this game, I was making 48 grand a year, I think. Okay, but now, if I go buy a $4 million building, well, versus a portfolio of 200 or 300 million. Right, that property can go bad, and we're still going to service the debt because I have enough excess cash flow to service that debt, and I can maybe do it for several deals if they go bad because they're just not big enough. But I could get myself in the same kind of trouble if I went and bought a $70 million 400-unit luxury apartment complex in Dallas. Like if the numbers started trending the wrong way on a $70 million property, that's going to cause me a big problem. So it's kind of sticking with the size of the deal for your ability to service the debt if it does go bad, and you kind of grow with your deal size that way.
And I would also say too, I mean, the team that you have around, like you guys, right? You have a good team around you. When you start out, you'll start meeting more people, and you need to make sure you have a good CPA or somebody that can do financials. You need to make sure you have somebody you feel good from a leasing agent standpoint. An attorney eventually. So you need